Imagine watching the markets on a quiet Tuesday morning. No alarms, no red banners, just a thin, sudden move in an obscure military ETF. Someone's buying protection. Not much, just enough to feel wrong. And then you see it again. A spike in oil futures, a surge in shipping insurance. Still no headlines, no government warnings, no troops mobilized. But the money is already moving like war is inevitable. You've probably never heard of this market. It doesn't advertise, it doesn't predict elections, but it does something else, quietly, consistently. It flinches before missiles fly. It hesitates before tanks roll. Today, you'll see what they see, the hidden trading patterns that flash before the world catches fire. And once you learn to read them, you'll never look at a sudden conflict the same way again. At 5 a.m. in Singapore, the world still sleeps. The air is still. The glow of trading terminals washes the room in pale blue. Silence reigns until a single options trade appears. Small, precise, almost invisible, unless you're watching closely. No breaking news, no geopolitical tension on the wires, just a pulse on the screen, too perfect to be coincidence. It's a defense-linked derivative, a hedge placed exactly 2 weeks before tensions erupt in a region no one's watching. It shouldn't be there, not that early, not that accurate, but there it is, like a tremor before the quake. This isn't speculation. It's documented, archived in trade logs. In 2014, weeks before the world woke to tanks in Crimea, a handful of traders positioned themselves in Putin-exposed options. The tanks hadn't moved, no diplomats had warned, but the trades were already done. Some called it luck, but when the same pattern repeats across continents, across years, you stop believing in coincidence. Because these signs don't shout, they hum. A flicker in oil options, volume swelling in obscure defense contracts, then subtle shifts in currency hedges. It's like watching heat rise off pavement, only visible if you know how to see it. Now shift to London, midday. A trader sips lukewarm coffee. His feed shows a slight uptick in credit default spreads for a Middle Eastern nation. Not enough to trigger alarms, just enough to raise one eyebrow. Hours later, a freight trader places a quiet bet. Then maritime insurance costs start climbing for just one region. No one says a word, but capital is preparing for something. These aren't retail trades, they're signals, precise movements that reveal one truth: someone knows. This market doesn't just reflect war, it anticipates it. It decodes it before the public sees the outline. Modern markets are layered, fast, opaque. The public sees volatility. Journalists chase headlines, but the real story happens in the shadows. OTC contracts, dark pools, custom hedges buried inside private ledgers. A few $100,000 placed correctly can ripple into decisions worth billions. In 2020, a sudden spike in Eastern European energy swaps lasted only hours. 10 days later, armed conflict. Same rhythm, same profile, an echo of every war that came before. That trade, the one that shouldn't exist, becomes the first breadcrumb. Not an accident, a habit, a fingerprint left in plain sight. And there's another layer: timing. The derivative moves don't follow news, they precede it. A discreet cable between embassies, a quiet troop movement, a buried memo in a defense ministry archive. Each political action followed by a financial ripple. small waves, each timed just right. Let this sink in. The world's most powerful institutions, banks, sovereign funds, military analysts, they already watch these patterns in real time. It's their early warning system. But for the rest of us, we wait for news anchors, for official statements, for the narrative already shaped and softened. So when we talk about a trade that shouldn't exist, we're not talking about risk. We're talking about the first page of a war diary written in derivatives. Because today, war doesn't start on the battlefield. It starts in balance sheets, not with shouts, but with whispers. And once you see the pattern, you realize the market has already painted the future. They just never show the public the canvas.
They don't show up in the headlines. They don't trend on Twitter, but they're there, buried deep in the plumbing of global finance. The signals that say something is coming. Every market has noise, but in the right corners, the noise shifts. Defense ETFs gain volume without news. Gold futures spike without inflation. CDS premiums on fragile economies, Greece, Turkey, Taiwan, tick upward with no immediate cause. These are not anomalies, they are patterns. And the people who know how to read them aren't watching CNN, they're watching volatility curves. Start with credit default swaps, insurance against debt defaults. When war is on the horizon, sovereign CDS don't scream, they twitch. They price in uncertainty days, sometimes weeks, before a conflict becomes visible. In early 2022, CDS spreads on Ukrainian bonds widened quietly. No statements from NATO, no troop videos, just widening spreads. And behind them, quiet money moving out. The kind of money that doesn't panic, it prepares. But CDS is just one layer. Look deeper. Look at energy derivatives, contracts that move not on price, but on expectation. If traders think a pipeline will be disrupted, they don't wait for the explosion. They hedge before the tension even hits the papers. That's how oil options became one of the most reliable war signals in the last decade. Not because oil causes war, but because war changes the flow of oil, and those who depend on it move early. Still deeper, maritime insurance. Insurers don't broadcast their fears, but premiums speak louder than press releases. When ships reroute, when coverage costs jump in narrow corridors like the Strait of Hormuz or the South China Sea, it's not speculation, it's capital rebalancing for chaos. Then there's volatility indexes, VIX offshoots tied to sectors like aerospace or cybersecurity. Before a single shot is fired, they glow red, briefly, sometimes for an hour, sometimes for a day. Long enough for those paying attention to say, that wasn't random. The signals are not coordinated. They don't come in a press kit, but taken together, they tell a story. And the story is always the same. Someone knows. The markets are not omniscient, but they are fast. They respond to whispers, logistics delays, embassy alerts, contract freezes, unusual satellite activity. None of this is public, but someone trades it. Not because it's illegal, but because it's legal and opaque. A perfect playground for those with privileged insight. And once one player moves, others follow. Like a ripple through water, the early hedge becomes a pattern, a sequence of trades, too diverse to be noticed, too synchronized to be coincidence. This is where the invisible becomes undeniable, where silence turns expensive. Because once the public sees the war, it's too late. The real gains, or protections, already happened. And the next signal? It's already blinking. You just need to know where to look. Where you are determines what you see. In global finance, geography isn't just location, It's leverage. Some cities don't wait for headlines. They receive signals first, faster, quieter, cleaner. Take Langley, not a financial hub, but just down the road from the CIA. And through InQtel, its venture arm, capital flows into companies focused on risk modeling, data surveillance, and geopolitical disruption. They don't trade on headlines, they move on pattern recognition, intercepted signals, and data that never makes it to the news cycle. Then there's London. Behind the polished banks, in private offices across Mayfair, you'll find family funds reading classified grade briefings, written not by journalists, but by ex-military, intelligence veterans, and geopolitical risk firms. They don't ask if war is coming, they ask how to price it. Singapore? It's not just a financial center, it's a front-row seat to Asia's pressure points. When a carrier shifts course in the South China Sea, traders there see it before the West even notices. Freight rates move, insurance adjusts, and capital flows accordingly. Even Zurich plays its role, where discrete banks serve clients with geopolitical exposure, Russian oligarchs, Middle Eastern royalty, exiled billionaires. They don't react to public news, they react to whispers. Geography creates proximity. Proximity creates access. And in finance, access is everything. You won't find these movements in public dashboards, but look close and you'll notice options on regional currencies spike. ETF allocations quietly rebalance. Insurance premiums edge higher in just one corridor. Too narrow to be noise, too early to be coincidence. There's no single war market, but there are clusters, networks of insiders positioned close enough to the signal to move while the rest of the world waits for confirmation. Because in this game, certainty is expensive, but proximity pays. Not all portfolios are meant to perform. Some are built to survive. In the world of high finance, there's a layer few ever see, a portfolio that doesn't chase returns, but hedges against collapse. It's not listed, it's not advertised, and yet it moves quietly in the background of every major geopolitical shift. This is the shadow portfolio, a hidden allocation of assets designed to thrive when the world breaks down. It holds defense stocks, but not the obvious ones. Instead, small-cap suppliers buried deep in the military-industrial chain, companies that manufacture thermal optics, naval-grade adhesives, satellite shielding tech, tiny players invisible to the index until war makes them essential. Then there's energy, not just oil, but obscure refiners, transport insurers, and storage contractors, because in times of conflict, control over movement becomes more valuable than the fuel itself. It includes currency plays, long on stability, short on chaos, Swiss francs, Norwegian krona, bets against vulnerable nations with weak reserves and political volatility. Some go further. They buy food infrastructure, grain logistics, water rights, cold chain networks, because supply lines, not weapons, often decide who lasts longest. And threading it all together, derivatives. Not the leveraged kind you see in retail, but the bespoke instruments, custom-built, over-the-counter, negotiated in private. Options on war risk insurance. Contingent swaps on political regimes, contracts that pay out if borders are redrawn. These portfolios aren't designed to win headlines, they're designed to disappear, to hedge against a reality that most still believe is unlikely until it's not. They don't spike overnight, they hum in the background, quietly outperforming when everything else burns. And the people who hold them? They're not betting on war.
They're preparing for its inevitability, because they know when the world panics, the shadow portfolio doesn't blink. Some trades don't leave a trace, not because they failed, but because they were designed to vanish. After every war, there's debris, ruins, statements, sanctions, and beneath it all, market data. Investigators arrive late. They scan for anomalies, unusual volumes, asymmetric timing. They find activity, but never names. The trades were routed through shell entities. The orders split across jurisdictions. The footprints washed clean by design. This silence is not an oversight. It's a feature, because in high finance, invisibility is an asset. In 2003, oil futures surged days before the Iraq invasion. The volume was real, but the accounts? Domiciled in the Caribbean, closed by the time anyone asked questions. In 2022, defense stocks moved in eerie anticipation of Eastern European escalation. Funds with ties to offshore trusts and multi-layered custodians. By the time disclosures were due, the spike was old news. These trades worked, and that's precisely why they disappeared. The deeper you dig, the more sanitized the data becomes. Regulators have access, but rarely incentive. Auditors find questions, but rarely answers. Because once you follow the money far enough, you don't just find risk managers, you find lawmakers, consultants, senior advisors with overlapping titles in government and finance. And nobody wants those names to surface. So the trades fade, the questions stop, the silence holds. Not because the system is broken, because it's functioning exactly as designed, to preserve confidence, avoid panic, and protect certain players from scrutiny. But silence has limits. Now and then, a leak breaks the surface. An internal email, a whistleblower, a delayed filing that reveals too much. And for a brief moment, the illusion cracks. You see how markets assign value to war, not through speeches or memorials, but through volatility premiums, hedging ratios, and liquidity pools. In that instant, silence isn't just expensive, it's priceless, because it guards the one thing more valuable than money: plausible deniability. By the time most people hear the word war, it's already too late. The trades have been made, the portfolios adjusted, the risk transferred. Because in this system, war doesn't begin with generals. It begins with capital. And the people closest to that capital, they don't wait for certainty. They read signals, movement in obscure options, ripples in shipping insurance, anomalies in commodity flow. It's not prediction, it's preparation. You've now seen how money whispers before the missiles fly, how silent markets flash red before sirens ever sound, how conflicts, long before they reach the news, are already priced and sometimes monetized. So the next time you see a sudden move in oil, a surge in defense ETFs, a currency hedge that makes no sense, ask yourself, what does someone know that hasn't reached you yet? Because the market doesn't just reflect reality. Sometimes it reveals what's coming in ways the headlines never will. If this opened your eyes, share it with someone who still believes war is unpredictable. And if you want to keep uncovering what moves behind the curtain, what the system hides in plain sight, subscribe, like the video, because the next revelation is already unfolding. And when it does, you'll want to be the first to read it.